welcome to the Russell Investments Masterclass. I'm Scott Fletcher. With me today is Andrew Sneddon, Portfolio Manager of Russell's Australian Diversified Funds. Andrew, welcome to you. There's probably no better way to kick off our Masterclass series than to look at the question as to what drives investment return. In your experience, what do you think are the key drivers of investment return?
Scott, there are four key drivers of investment return for a portfolio. The first is strategic asset allocation. That's to say, the choice of asset class to put in the portfolio and the weighting of that asset class in the portfolio. That's by far the single most important driver of return. The second driver of return is active asset allocation, and that recognises that through an investment cycle, a particular asset class is likely to be very cheap at certain times, and at that time we're going to want to overweight that asset class to maximise returns for investors. The third driver of return is manager selection, and manager selection is about having the best available active manager in each asset class to ensure that we maximise returns. The fourth and final driver is implementation, and in implementation there are a number of potential costs and leakages that can be lost in executing the portfolio. But by utilising a professional trading desk, like our 24-hour trading desk here at Russell, we minimise implementation leakage and therefore maximise returns for our investors.
You mentioned active asset allocation as one of those key drivers. Can you take us through in a little more detail how this works in practice?
Our active asset allocation process, Scott, is called strategic tilting. And in strategic tilting, where myself and the other investment professionals at Russell focus our time, is really on what the catalysts that will drive cheap asset classes back up in value towards their true fair value. And probably the most important single driver of that is demand for an asset class. And one of the real benefits we have here at Russell with our $2 trillion of assets under advice is we have daily real-time access to the world's largest and most influential investors in each asset class in which we invest. So for example, in June 2009, in the wake of the global financial crisis, corporate bonds were cheaper than they had been at any time in the 40-year history of the bond market. What gave us conviction though to take an overweight position for our clients is that we began to see some of these large influential investors starting to buy them as well. This gave us conviction that there was demand for them. We therefore overweighted them for our clients, and that really enhanced returns for our client portfolios in the second half of 2009.
And just finally, digging a little bit deeper into manager selection as a key driver of return that you mentioned, how do you incorporate manager research into the Russell Diversified Funds?
Good active manager research is critical to success because, Scott, we want to make sure we maximise the return in each asset class where we're invested. So at Russell, we undertake more than 3,000 site visits all around the world every year, looking for the best manager in each asset class, and importantly, then providing access to that manager to our clients here in Australia. So for example, following the global financial crisis, we introduced global listed infrastructure as an asset into our portfolio. And the best manager we found wasn't in London, and they weren't in Manhattan, they were in the Midwest of the United States. They had no clients outside of America and no way for clients here in Australia to access them. That manager, Nuveen, we brought into the portfolio, and they very strongly outperformed their benchmark for us in their first year.
Andrew, thank you very much for sharing your insights with us today. And thank you for joining us, and we look forward to seeing you next time with the Russell Investment Masterclass.